There is no other collateral in the world like gold except silver. You can't destroy it. You can't fabricate it. It's forever. It's fungible. There's no crop. There's no blue silver or red silver. There's just silver. And so therefore, and it doesn't rust and it doesn't get consumed. And so therefore, it is collateral. The question is, what's it worth?
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today's guest is Vince Lanci, a seasoned global, macro, and precious metals strategist, veteran commodities trader, and the voice behind the influential VBL GoldFix Substack, where he dissects the real drivers of gold and silver markets beneath the headlines. Vince connects policy, geopolitics, and market structure in a way that helps do-it-yourself investors understand who is really moving the tape and why. He's here to walk us through what's happening behind the bid in gold and silver, how liquidity and central bank behavior are reshaping price discovery, and what it all means for anyone trying to protect and grow their wealth in this new monetary era. Vince, thank you for coming back on the show.
Well, thank you for that gratuitous complimentary intro. Thank you for having me. Happy to be here.
You're welcome, sir. Thanks for coming on the show. Let's start out like we always do. And what is your macro outlook for the world economy and financial markets today?
Oh, yeah. We didn't prepare that one, so I'm going to have to make it up. We didn't prepare much of anything on these world economy. You know, I actually have not been focusing too much on that of recent in terms of the recent macro drivers. But I will say that the overarching theme is no matter what happens, looking at the 1 to 5 year time frame, governments will continue to print for ostensibly good reason to rescue their economies while they're paying down their debt or actually adding to their debt. My feeling is that if you go to the three corners of the world, those three corners being the US, Europe, and Asia, every major nation, G8 economy, let's call it, is printing money. And they're printing money for different reasons. Japan is printing to pay for its own defense, even though they're fighting inflation. China is printing to make sure their economy doesn't go belly up. And they're also going to have to start printing to increase their social safety net. Believe it or not, they don't have one. Europe has to print and increase debt to rearm, to defend themselves against Russia. And the US has to print because we need to reindustrialize manufacturing. So all these things are happening at the same time. And people in the past, like Jim Rickards, would talk about race to the bottom or currency debasement. We're in it now, but it's just not happening the way that we would expect it to be. Banks are going to start cutting rates less going forward because at the fiscal side of the plumbing, governments will be spending more. Tax rebates, tax subsidies, checks in the mail, price caps and price controls. Those are the signs of a world economy that is trying to change its engine, its economic engine, as if it were a car while it's on the highway. So it's got to change what's driving the economies in all these nations while not stopping. So that means they're going to spend money on social safety nets while spending money on refurbishing or rebuilding what they have to. And that means the goods, to give you the good bottom line scenario, the good bottom line scenario is it's either 1971 to 74, which is where we inflated and the economy did well. That's the boom scenario. Or it's the 1976 to 1977 scenario, where that 1971 to 74 timeframe went its course and we were throwing good money after bad and we ended up with stagflation. So every central bank out there and every government out there, it is my opinion, is looking at the two choices going forward. Recession or depression is not an option. Not an option, okay, for anyone, right? Number one. Number two, that leaves a good economy, Goldilocks, which ain't happening, or inflation versus stagflation. So you have recession, which is at the bottom. That's not going to happen. Then you have a good economy, which is what they hope for. And then you have the two outliers. And if it looks like we're headed to stagflation or recession, they'll print more. So I think uh, an increasingly K-shaped economy will probably happen for non-investors. And for people who are hedged properly, whether it be with equities that are inflationary hedges or precious metals or some other real asset, uh, Bitcoin or commodity producing companies like uh, rare earths or miners, I think those people will be better off. I hope that helps.
Yeah. Okay. So for the next 1 to 5 years, you basically see governments around the world, US, Europe, and Asia, just continuing to print. Each of them
Right.
doing it for different reasons, but they're all basically arriving at the same conclusion. We're starting to see price controls, stimulus checks, subsidies going out, and how can I say this? Politicians don't get elected so that we can take our medicine and move on. They get elected so that we can postpone recessions, and the only way out of that, is either stagflation or inflation, and they're going to take inflation every single time. So we're either
Right.
playing out the 71 to 74 boom or the 66 to 67 stagflation, and you're kind of betting on they're just going to try to print their way out of it.
Right. 77 to 81 stagflation. Right.
Oh,
Right.
77 to 81. Okay.
Yeah, the one that came afterwards. But I think something that's not discussed enough, but should be discussed, is with regards to the price control comment I made. If some of your audience is old enough, you look at uh, Nixon's presidency, okay, and other than the severing the gold standard tie, he did a couple things that were very ham-fisted, but back then we didn't know any better. He literally used price controls and he froze wages. It was all at the same time. And that was to the idea was he wanted to continue to pump money and because he was having them, but he was capping salaries and capping prices to make sure that money flowed where they wanted it to. Now, how is Trump doing that? Well, he's not going to call it price controls, but I want every time Trump has been saying power prices are too high, I'm going to get utilities to lower the prices. Pharmaceuticals have to lower their prices. Okay. When he does all these things, he's going industry by industry using price controls. He's going I mean, it's not a bad thing. He's pinpointing price controls. So what did he start with? He started with big pharma, right? He started with your prices are too high. And Biden did something like that too. But that's a price control. Find out where people are crying the most and limit their upside. So that's bad for these stocks. And by the way, big pharma did get slammed, and now they recovered very nicely because a deal was cut. And I don't want to be too cynical about it. So you've got utilities are next. You're going to start hearing power is too expensive. I'm going to go after the companies that charge for power. I'm going to go after this company. I'm going to go after that company. What he's really doing is he's one at a time doing what Nixon did, but not announcing it. And that's the way the United States operates now. I say this to people say, are they going to confiscate gold? No, they're not going to confiscate gold. They're just going to ruin the on-ramps and off-ramps for you to get access to it. And so they're not going to use price controls. The government's going to do it the Republican way, go after industries, or it's actually populist Democrat way, go after industries. But we are doing price controls now on the salary freezes, right, which Nixon did. Well, that's easy. AI is doing that. AI is going to get people fired, and that's going to and the immigration coming in keeps a little in prices. So we're controlling wage inflation by basically decimating the workforce with people that aren't paid as much, and at the same time, uh, we have AI coming on that's going to reduce the need for employment. So effectively, Trump is in the middle of doing something like Nixon did, although he may not be doing it, he may not be thinking it. But isn't it interesting? I mean, as an aside, that Nixon was probably the most liberal Republican in a long time, had to be, but that's where he was. And now Trump is doing the same thing. And I would say that economically, their policies are similar out of necessity. So price controls are the thing that no one really pays attention to, but we already have them. It's happening now.
Okay, I studied that period a bit and I didn't put that together, but you're absolutely right. Trump is saying a lot of that. So he's essentially following Nixon's playbook, but doing it a lot more covertly and
Yeah,
essentially setting us up for it, which was, and like you said, salary wage inflation. I think AI may take care of a lot of that. Um,
yeah. I mean, like, what are they doing in Italy right now? They're like, uh, 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 tell us how much gold you have. They're not going to do that in the US. They're just going to make it hard to get. You know, they're going to tax the companies that sell the gold. Coin dealers will be put out of business or something. Anyway, I'm digressing, but you get my point. Yeah,
yeah.
we're subtle now. We're neo-Keynesian. We're not stupid anymore.
Yeah, yeah. Okay. Okay. All right. We got a lot of questions here. The first world problem. So many questions. Let's go lightning round here.
We're
And
doing the questions right away. Okay,
uh,
fine.
yeah, yeah. We'll get into questions right away. We'll just go right down the list here.
Okay.
As far as Fed and macro, Coffee Stocks wants to know, he said, if the Fed has many tools to adjust the market, what is the last tool you think they will use before the dollar loses its status?
Right. So the answer to that is yield curve control. But I just want to, I know Coffee. I want to address what Coffee's saying there. You notice that Powell says he has a lot of tools. No, they don't. All their tools are the same tool. All their tools are ways to distort the market so that the bond yields stay down and the problem comes out in the money. So all their tools do the same thing. They're either printing money here or they're printing money there and moving it here. So what is yield curve control? I want to answer that very quickly. Yield curve control is where the government, and this is going to be important, I think, when we talk about this as we go down the line. When things get bad enough, Coffee, and we're nowhere near that, the government, the Fed will do something called yield curve control, which is essentially capping long-term rates to give the illusion that there's no inflation, and then borrowing short term, which we're already doing. And we're doing that even more under Besant. And basically, you have a yield curve of the long term rate is fixed, right, by the government stomping on it. And then the short term rate is fixed by the Fed. And then all the air in the balloon comes out in the dollar, and the dollar goes down. So that is the last tool that they will do. And they will do that to protect treasuries, not dollars. Dollars will go down and treasuries will be saved. And that'll be the last tool they do. Next.
Okay. Yield curve control. Basically allowing the dollar to inflate away, but fixing the treasuries at a lower interest rate. And that's kind of how they basically engineer inflation and get rid of it. Okay. Asset allocation investing strategy. Tupac wants to know, what asset allocation percentage would you recommend for the average investor? He's talking about gold and silver. Let's say in a portfolio, about what percentage would you allocate?
Oh, well, I mean, I think it varies from person to person. I think this is the person, for the average investor, I see. Um, geez, I'll just say something. I'm going to give you a blanket answer. I'm not going to talk about any individual investor. I'll just give you a framework to think about it. Do you own your home? If you own your home, what is your net worth? Net worth. And once you have your net worth, um, do you have 6 months of money in cash or cash equivalents? Cash equivalents for me would be treasuries or money markets. Um, if you have your net worth quantified and you have 6 months in cash, then it's somewhere between, and this is not an answer you're not going to get the right answer that you're looking for if you are looking for one. It's going to be north of 10% and less than 40%, which is a horrible thing to say. But I could just tell you that, it depends on how old you are. If you're young, it should be 10%. If you're old, it should be 30 to 40%. It's a demographics question, right? Are you buying Nvidia when you're 20? Yes. Are you buying Nvidia when you're 80? No. So it's really about demographics. But I would say the first thing to look at is what's your net worth, and if let's say you're of the median age, the mean age, let's say that means 25%. Let's say it's 25%, right? I would say, well, do you own your house? Yes. Then maybe it's 15%. Do you not own your house? Correct. I don't own my house. Then maybe it's closer to 40%. That's how I would look at it as an inflationary hedge. Next.
That I've asked this question so many times, and I think that was the best answer I've ever gotten. I really like that, especially the 6 months of living expenses in cash. I think that's key.
Yeah, Steve, it used to be 90 days. That was the rule of thumb, 90 days. Now it's 6 months because shit, if you get fired now, you're not getting rehired. At least in my generation.
Yeah, yeah. Okay, gold and silver market dynamics. James wants to know, what should a gold and silver stacker be thinking about when he wants to sell back some physical in the next 2 to 3 years?
That's a good question, and it's a question that I have spent a lot of time thinking about and talking to other people before I was heavily involved in physical. And the answer is all you care about is exit liquidity, right? If you know that you're going to be selling in 3 years, and I do not know I'm going to be selling in 3 years, but my children may be selling in 3 years. Who knows what emergencies they'll have? I want to make sure that they can get close to what it's worth. And that means you stay away from numismatics that you want liquidity in. You stay away from the Spider-Man coin. You stay away from the Superman coin, and you go with the coins. If you're going with coins, right? You go with the coins of the nation that you're in, or American Eagles and Silver Maples. Now, I'm not anti-harmonic. I'm not anti-Philharmonic. I'm not anti-Kangaroo. I don't live there. I mean, look, if it's Armageddon, I'm not going to go into a store and ask for a, ham and cheese on rye with a Philharmonic. I'll show them American Eagle in silver, and they'll say, okay, I'll give it to you. Nobody's going to. Exit liquidity is extremely important. So you want to make sure you have something that's exit liquidity. I'll give you another analogy. Two high-end watches, Rolex and JJ LeCoultre, right? Now, JJ LeCoultre's really high-end. I mean, there's stupid super high-end, but there's JJ LeCoultre super high-end and Rolex. So you buy both of these watches for, let's say you spend $30,000 on a watch, a high-end watch, right? Okay. You walk out of the store, the LeCoultre is $15,000 if you have to sell it. The Rolex is 28. Now, why is that? Exit liquidity. There's a secondary market for Rolexes, not for LeCoultres, not for JJ LeCoultres. There is a secondary market for Eagles, for Maples, and Kangaroos and Philharmonics if you're in those countries. So the answer is exit liquidity is all that matters. And for me personally, it's American Eagles and Silver Maples. People like Buffaloes as well, American Buffaloes, because it's 24 karat. I don't care. It's close enough. I like the fact that it is truly a currency in that respect. So that's my answer for there.
Okay. All right. Exit liquidity, no numismatics, and stick to the sovereign mint that's closest to you. Hugo wants to know, is silver very risky with a major crash coming, or will it hold because of the shortage in production?
Oh, yeah. Well, I think in terms of degrees, so if you're saying a 5 or 10% crash, that's not a crash, right? The word crash is like 20, 30, 40, 50%. So if there's a crash, nothing will hold, right? So, but let's throw some numbers on it to make it a little bit more helpful. If stocks were to drop 10%, then silver would drop as well, okay? It would move in tandem because for the next 1 day to 6 months, that would happen. And it would happen because the industrial demand of silver would decrease because you'd be fears of a recession or a depression or what have you. And it would decrease because even though it's monetary, it would not be linked to gold. Now, that's if the crash is purely a deflationary crash. If assets crash. Now, but we're increasingly more of a dynamic world. Suppose China's economy crashes. Does silver go down or up? I don't know the answer to that. I think silver could actually go down if China's economy crashed, and gold could go up. But we're not going to focus on that. I just want to say that the reasons for stock crashes now are diverse. If it's geopolitical, if the U.S. stock market crashes because China comes out and says, "Hey, we've got AI that's cheaper and better than the U.S.," then silver goes up. And that would happen because the U.S. would have to throw more money at it to compete. It would be more inflationary. We would just throw money at the problem, which is what we do. So it used to be an easier question to answer, and that answer would be, well, it'll go down at first, and then you buy it and it goes up. But the answer is in a crash, if I know a crash is coming tomorrow, I sell, and I can only trade silver, gold, and copper. All right, let's look at it that way. If I know a crash is coming tomorrow and I can only trade silver, gold, and copper, I sell copper and buy gold. Therefore, what would I do with silver? Well, I don't know. It depends on the cause for the crash. If so, the answer is I would be flat silver, but it will probably sell off as well, unless it's a very narrow issue. So I can't really answer that question as easily as I used to be able to. It's a high beta version. It's a high beta stock, you know? That's it.
Yeah. Okay. All right. During a crash, nothing holds, but if you had to choose between those three metals, you'd be selling your copper and buying gold and probably hold silver.
Staying away from silver.
Oh, selling copper, buying gold.
As a trade, staying away. As I wouldn't buy it or sell it on the lows. How's that? If all three metals drop to the lows on a crash, right? I'd buy gold. I wouldn't buy silver, and I might sell copper.
Okay,
that's the answer. That's my answer.
All right. Cal is asking about deficit here. There's already been a deficit in silver for 5 years. AI build out, energy demands, remonetization in India. Why isn't silver higher despite 70% year-to-date gains? What are the drivers to $100 silver, and when do you think that's coming? Is above ground supply larger than thought?
All right. Well, let's ignore this year and let's just focus on the fact that silver is undervalued. Okay. Let's do that to answer this question. So the first part of this question, silver's not higher despite being in deficit for 5 to 10 years, right? It's the deficit's actually starting to decrease now. It's dropping the deficit is increasing at a slower rate now. So the acceleration is dropping a little bit. So the first question is, ignoring 2024 and a half to 25, why was silver not higher given the deficits? And the answer is, not being cynical about it, fundamentals don't matter until they matter, right? And fundamentals have been bullish for silver for quite some time. And they didn't matter because flows have been overwhelming silver. So for example, above ground stocks. Look, before anyone mined silver, the banks, which are the biggest players, the bullion banks, yeah, and I could say that they're manipulating the market, and they are. They have been, but that was the market structure dictating that to them. But if I know that there's a problem in silver, the first thing I'm going to do as a bank, I know everything. I'm JP Morgan. I know everything about silver. All right. First thing I'm going to do is I'm going to go to all my nickel and lead producers, and I'm going to say, give me your scraps. And they're going to have leavings or you heap leach silver out of waste product, right? So they're going to pull that. I'm going to take that and I'm going to have more silver. And I'm going to keep relying on clearing out people of their waste product. And then I'm going to go to miners and I'm going to, by the way, this is what China is literally doing right now. China has been for the last year going around first to its own people. Hey, who's got piles of waste? I want the silver out of that. That's the CCP. And then they go into Latin America and they say, hey, who's got concentrate? I want it before it's refined. Give it to me. I'll pay for it. So that has been going on for years. And in combination with the fact that silver is heavily invested in by normal people, princes as opposed to kings, you have a lot of turnover at the coin area. So, I mean, at the investment area. And so above ground stocks, which have been able to be found, there has been much more than people understood. Cheap production, because you could just heap leach it to get more. And substitutability, you don't need silver for this. You can use less for that. And offloading, but the other one is offloading. So since the 80s, we've been telling central banks to sell silver, telling nations to sell silver, and that takes a long time to work through. I would say this to you, that the psyche of the silver market has been damaged for so long by such successful propaganda keeping it down that it takes a generation for it to be fixed. So that's why it has been the way it has been before this year, right? So 2025, in my opinion, is the beginning of that coming of age or coming out or generational turnover, the fourth silver turning, for lack of a better word. And so now you're asking what are the drivers to $100 silver and when? Okay, I'm not going to answer when, and I'll tell you why in a second. And it's not a bad question to ask, but it's a foolish question if anyone answers. All right, for commodities, and I'll tell you why in a second. I am now mapping the path of silver higher on the same path uh, that lithium and uranium have been on, and that path is uh, in 5 years. Like my math, I actually did the math on these things. On my math, silver within this is not crazy bullish tomorrow, but this is what's happening. Silver should be $144 within 5 years. Period. $144. Now, why do I have that number? Because I did some regression. I said, well, when lithium became a critical mineral, what happened? When they announced uranium, what happened? Well, they announced silver. And what happens inevitably, without a doubt, is that demand gets subsidized domestically. Oh, we have to buy silver. Let's buy it. The government gives money to companies, spends money on companies to pull more silver out of the ground. Let's say that the government were to just say, all right, we're going to give $1 billion to a company to mine silver. Well, what does that do? That makes the price of silver go up. Even though we're pulling more silver out, the immediate demand has to hit the future supply. And that takes a lot of time. And so when you have a mechanism like that, critical mineral status, you look at critical minerals and how they acted before. And I'm looking at silver as compared to lithium and uranium. And I have a post on that. I've done the work on that and I've shared it. And it's actually done quite. People don't care about it. They want silver to go up to $100 tomorrow. But so here's the next part is when. Okay, I'm going to paraphrase something Keith McCulloch at a Hedge Eye said, and he said something that's near and dear to my heart, but he said it in a way that was very, very academic and very quant, and that was this. When you go into an exponential phase of a market, silver, I don't care what it is, it gets stupid, and you can't measure how stupid it gets. All you can say is at every checkpoint, you look to see if the drivers of the stupidity are still there, right? And I don't mean to say buyers of silver are stupid. What I mean to say is, I say to you mathematically, fundamentally, $144 is worth what silver's worth. Let's pretend that I'm right. It's probably going to go to 250, right? So for the 20 years, through the 10 years that silver was undervalued from the fundamentals, it's probably going to be overvalued for the fundamentals. And that's the nature of silver. So when we get into a more exponential phase, that's the point. Exponential phases are not definable. It's like, the market hits a patch of ice and just starts to go. So it could go to, I can tell you go to $500, right? I'm not saying that, but it goes to $500. It won't be there for more than 5 seconds. You won't be able to sell. The sustainable real price over the next 5 years is $144. That's my number. Call it $150 if you want. So that's my answer. If anyone gives you a time frame, if anyone gives you a price, tell them why. Ask them why, which I just did. Here's my price. Here's why. It's a candle in the darkness. If anyone gives you a timeline, and that timeline is based on fundamentals, tell them they're morons. If they give it to you based on technicals, say, okay, I understand that because they have a timeline. If it doesn't happen, it doesn't happen. But generally speaking, anyone who gives you both a price and a timeline, laugh at them because it's a commodity and an exponential phase is an exponential phase. May as well flip coins and bet it's going to land on heads 10 times in a row. That's my answer there.
Okay. Deficit's actually decreasing. I like what you did there, connecting critical minerals, it making the list and then basically projecting that out since silver just made the list, you could project that out in around 5 years, $144. It'll probably overshoot.
Yeah,
Okay.
it'll probably overshoot, right? Right.
Yeah.
Or to add to that, are they going to come up with reasons to use less silver? Yeah, they're going to use less silver per solar panel. And you know what that means? The price of silver will go up because more solar panels will be made. It's like when the car was automated, when cars became affordable and mass produced. So there's nothing that's going to get in the way of the industrial side of silver unless they start using aluminum instead of silver, which could happen. Doubt it though.
Okay. All right. We got to enter the super lightning round here, Vince.
Yeah.
Writer wants to know if gold revalues fast, for example, if they do a 50-year gold-backed bond, what happens to silver short and long term? Will it catch up to the gold-silver ratio or lag?
Yeah, short. Okay, so without putting a time frame on short or long term, it makes it hard to answer. But I'm going to say I'm going to approach this straightforward. If gold revalues, whether it's a 50-year bond, and I don't think a 50-year bond would necessarily revalue gold higher, but it could. Or China makes an announcement, we're going to use gold. We're going to give everyone gold. Whatever the reason, here's my answer. My answer is another framework. The less available gold there is to invest in, the lower the silver gold ratio goes. Okay, so why am I saying that? I'm saying that because in 2021, when John Paulson got back into gold, he said he admitted a couple of mistakes he made before. And he said, I'm getting into it this time because the gold that's going to be bought in the future will not come back on the market. And there will be, as a result, less available gold to invest in. Meaning, paraphrasing Pozar, less collateral available, less gold to lease, more gold used financially for repo, which is going to come in China, I think. And the reason that affects silver the way I'm saying it affects silver is because when the world wakes up, not when it's in the process, but when it wakes up to the fact that there will be less gold available, it will start substituting. And when the substitutes start to happen, they'll happen in terms of nature. So here's what I mean. I'm in the dark, and now gold all of a sudden is $15,000. Just to pretend overnight is $15,000 worth of reason. So what's silver worth? I have no idea. Why was the gold bought? I don't care. I mean, I do care. Normally I care as a trader. But the higher gold goes in price, the more everything converges to nature. So at $15,000 an ounce, I'm going, well, I can't afford gold. What can I get? Well, there's only 10 times more silver than there is gold. So silver's worth 1,500. So I'll buy it. And when you have big moves like that, the market looks to nature. And I'm not I sound like I'm talking like a hippie, but I'm not. I'll be China for a second. What's the easiest market to move to its true price? The answer is gold, because it's not used, because it exists, because it's in nature, and because it's decentralized. We can hoard it, or whatever you want to call them. And once we do that, because it's organic, because it's a mineral, well, its mining is tied to other minerals. And so therefore, as it occurs in nature, it shall occur in humanity. Look, for the last 50 years, we've been operating under a neo-Keynesian mindset, which is infinite metals, infinite gold. We can just do we financialized everything. And so as the gold collateral disappears from availability, that makes people look for other collateral. Now, I'll give you a real example of that that's happening right now. In the BRICS nations, Eastern nations, are now, it's not obvious yet, but if you look, you can find it, are now buying silver. So the central bank in Saudi Arabia bought SLV. Now, are they going to buy it and sell it? Who knows? But they bought it, okay? Russia is now accumulating silver, or saying they're accumulating silver for their central bank, which is basically like their critical mineral. There is no other collateral in the world. The Bitcoin conversation is different, but there is no other collateral in the world like gold except silver. You can't destroy it. You can't fabricate it. It's forever. It's fungible. There's no crop. There's no blue silver or red silver. There's just silver. And so therefore, and it doesn't rust, and it doesn't get consumed. And so therefore, it is collateral. The question is, what's it worth? And so gold and silver are the two purest forms of collateral on earth. And that's why gold is perfect money, because it doesn't get destroyed. Silver is almost perfect money. And the problem with silver is it is used industrially, and that makes it worth even more when it gets going. So nature will kick in when gold goes up. That's it. That's my answer.
Okay, that makes sense. And I know what you mean by nature. You're not talking granola. You're talking what is it found in the ground, and the ratio is
Yeah.
about 10 to 1, so people will naturally re-rate it to that level.
Right. And just that's a good point. To add to that, gold going to infinity to extrapolate means no more futures contracts. No more futures contracts means no more rehypothecation. No more rehypothecation means silver's going to trade 15 to 1. I mean, it's not going to happen tomorrow, but that's the idea. It's going to gravitate towards nature.
Okay. Okay. All right. Getting close here. We're going to take a deep dive for Premium Substack, but wrapping up here, Chris is basically asking about your thoughts on iShares Physical Silver and the Sprott Physical Silver Trustee. I think he's a little worried that there might be some type of confiscation. How do you feel about these physical bullion ETFs? So what risks do we have there?
Okay, I can't speak to Sprott at all, but I can speak. I have a relatively strong opinion that hasn't disseminated yet. So I'll share that here, and you can see how you feel about it applying to Sprott. Um, SLV and GLD are not real gold and real silver in the sense that you can't take delivery. And also in the sense that if I'm a bullion bank and I'm short silver or short gold, I can always hide those problems in my commingled piles, assuming that happens. I'm pretty sure it happens. I don't know how rampant it is, but it happens. Um, now, so they have a well-deserved reputation for being less than authentic. However, SLV and GLD are spot contracts, and they do have the metal. You just can't get it. Okay. Um, the movement away from the movement into what I call mercantilism all the time, or a deglobalized market means collateral is more important than futures. So if there is no trust among nations, then there are no futures. There's no trust, no future, no futures. Okay? Which means you got to have the metal, which means you got to look at spot markets. So where are the two spot markets? China and London. But the London spot market, the last one out of the room should just turn the lights off there because that market is done unless the US bails it out. That's my opinion. Or China. I think we are going to bail it out. And what I'm getting at is SLV is a spot tagged market. COMEX is a futures market. So if you were to look at COMEX versus SLV, you'd say, oh, SLV sucks. COMEX will be saved versus SLV. And I'm saying no, it'll be the other way around. SLV will be saved because we're directing American investors into it. SLV is a security, and the U.S. will protect its domestic products, its SEC regulated products, its liquidity pool. The American liquidity pool of investors is one of the most valuable assets we have. The CFTC governs COMEX. And what is COMEX? It's a futures exchange with a lot of metal. And guess what? It's open to the world to buy, and it's a real pain in the ass. So we could be depleted that way. So eventually, I think COMEX gets delinked from silver before SLV does, which is probably controversial to say. But I say that now because spot markets are more important than futures, because the world is deleveraging financially, and because we need to protect or ring fence our liquidity pools. And to give you some proof of that, JP Morgan, they're the custodian of SLV now. JP Morgan's too big to fail. They're not the custodian of COMEX. They're the custodian of SLV. We have to protect that, right? The spot market is what's going to matter. There'll probably be new products as well. The spot market will matter. And by the way, new products, stable coins, blockchain, silver and gold, that's going to be tied to banks that have metal. So domestic supply must be protected. COMEX will go, I think COMEX will be triaged before SLV. That's my opinion. Now, let's pretend that I'm wrong, right? Let's pretend that I'm wrong. If I'm wrong, then SLV will become a tracking stock. They'll say we're not going to get any more metal. It'll start to trade like a closed-end fund. It'll track silver, but it will track at a discount. Will it go to zero? Yeah, it could go to zero, but you'll have bigger problems if it goes to zero than that. COMEX will go to zero first.
Okay. All right. That was interesting. I didn't know that.
Well, that's my opinion. To be fair, look at LBMA. If there's no spot market in London, then the only spot market in the world is China. If let's pretend overnight China gets all the liquidity from London, London shuts down, then our futures are based on Chinese spot. And
Yeah.
if you think China can manipulate spot, they can, then you're at their behest. We lose pricing dominance. Pricing dominance over metals is one of the three or four pillars that hold the dollar as a global reserve. We need to protect the spot market. Either A, GLD and SLV will become dominant over COMEX, or B, we will rescue LBMA by sending more American banks over there to guarantee the vaults, like Citibank or Morgan Stanley. That's where I am.
Okay. All right. So you see the COMEX getting hit first, and look no further than who is the custodian of SLV, and you get your answer. Well done.
Right,
I did not know that.
Look, everybody, we all hate JP Morgan, right? Okay, as metals people, put yourself in JP Morgan's shoes. I have tons and tons of silver in a vault, and I have all my shorts on COMEX as a hedge. Let's see. Am I going to give them the silver if it goes up, or am I going to default?
Good point.
It's the contract versus the reality. Possession is 9/10 of the law. COMEX goes under before JP Morgan goes under. Therefore, SLV goes under after COMEX goes under. That's my logic. You default on your contract. You don't give them the silver. That's what they do.
Yeah.
That's how you do it.
Yeah. Very good point. Very good point. Vince, thank you very much. I want to give a shout out to your Substack. Love it. If viewers want to get a hold of you and follow your work, how can they do so?
Well, the Substack is VBL, Victor Boy Larry, GoldFix. So it's basically goldfix.substack with VBL in front of it. And on the on social media, I'm on X, Twitter, and you would just look for VBL's Ghost. But to be fair, I'm not so to the extent that I am, I'm not so eloquent and well mannered on social media. But you get the full boat there. That's it.
You get Vince raw and unplugged. I love it. Vince, thank you for coming back on.
But not political.
Not at all. Not at all. Vince, thank you for coming back on the show. What does Vince see for 401k retirement plans? Where does he see the dollar and the bond market going? And what does he see for the energy markets, specifically oil? Where does he see the gold to silver ratio going in the future? In other words, which metal should we be putting most of our money in? If you want access to that, plus updates on the stocks I'm buying and selling with real-time trade alerts, head over to Substack and join us. The link is down below in the description, or go to stevebartonmoney.com and sign up there. And if you're already a premium subscriber, check your inbox. The next video with Vince is waiting for you. Thank you so much for your support. Have a wonderful rest of your day.